You must be aware of the headline-grabbing events like the war in Ukraine, rising prices, higher interest rates, and the spread of COVID in China. It's pretty clear that this will have an effect on the world economy. But did you know that a third of the global economy will be in recession this year? Yes, this warning has come straight from none other than the head of the International Monetary Fund, Kristalina Georgieva. She has warned in no uncertain terms that 2023 will be tougher than last year, as the US, EU, and China see their economies slow. In this video, I will talk you through not only how the recession will impact your life, but also how the policies of big countries from many years ago led to the problems we're facing now. Let's get into it right away. In October, the IMF cut its prediction for the growth of the world economy in 2023. It was said that hundreds of millions of people will feel like they are in a recession, even though they live in countries that are not in a recession. One of the IMF's predictions is based on the war in Ukraine. Another important problem is high interest rates, which are caused by central banks around the world trying to control inflation. China, which has the second largest economy in the world, started to open its doors again after COVID, but experts have warned that 2023 will be hard for the Asian powerhouse. Let's start with China. The emerging superpower has been a key commercial partner for the Asia-Pacific area for many years, and it has also provided economic help during time of crisis. Asian economies are currently dealing with the long-term financial consequences of China's response to the epidemic. The official Purchasing Managers Index (PMI) for December showed that industrial activity in China dropped for the third month in a row, and at the fastest rate in almost 3 years. This was because coronavirus cases spread throughout the country's factories. China Index Academy, one of the largest independent real estate research companies in the country, did a poll and found that home prices dropped in 100 towns for the 6th month in a row in the same month. President Xi Jinping, who usually stays calm in all situations, was a little upset when he talked about this problem. He called for more effort and unity in China to enter what he called a new phase. As soon as Beijing stops zero COVID, factories could start making things like Tesla electric cars and Apple iPhones again. But just when inflation seemed to be at its highest point, rising demand for things like oil and iron ore is likely to push prices up even more. The loosening of China's internal COVID boundaries is not a cure-all, at least until the March quarter. The switch will be hard and cause a lot of uncertainty because of the US economy's slump. There is also reduced demand for goods created in China and other Asian nations like Thailand and Vietnam. For the next couple of months, it would be tough for China, and the impact on Chinese growth would be negative. The impact on the region will be negative. The impact on the global growth will also be negative, said IMF Supremos. 190 nations make up the IMF, an international body. They cooperate in an effort to stabilize the world economy. Being a mechanism for early economic warning is one of its most important functions. These remarks from the IMF will raise concerns for people all throughout the world, especially in Asia, which had a challenging year in 2022. Going back to interest rates, higher rates make borrowing more expensive, which discourages businesses from investing in company growth. Investors may withdraw funds from an economy due to a lack of growth, leaving nations, particularly those that are poorer with less money to pay for essential imports like food and energy. A currency's value versus that of more successful nations might decline during these slowdowns, aggravating the problem. To make matters worse, the war in Ukraine has been a major factor in the steady rise of prices throughout the Asia-Pacific and Europe. Businesses and households have suffered greatly. Governmental economies are also impacted by increased loan interest rates, particularly emerging markets, which may find it difficult to pay back their debts. And the crises from the past is what led to the current events. We are all aware of the terrible global economic crisis that occurred between 2007 and 2009 and became known as the Global Financial Crisis, or GFC. This crisis, which extended from the United States to the rest of the globe via connections in the global financial system, was sparked by a decline in the US housing market. Many banks experienced significant losses and needed assistance from the government to stay afloat. As the main industrialized economies went through their biggest recession since the Great Depression in the 1930s, millions of people lost jobs. After the GFC, many people didn't understand why the US government and a few European countries did what they did. Due to the risk of a very bad financial spread, the United States stepped in and the Federal Reserve started buying risky assets with money from its balance sheet. Also, the ECB and Japan did the same thing. In the end, many countries used it. A group of pseudoscientific economists came up with the modern monetary theory. This theory basically said that you can keep printing money and putting it into the economy to keep things running smoothly and really create long-term growth. It turns out that many people in government were fooled. Fast forward to 2022. In 14 years, around $30 to $35 trillion were put into the economy by countries around the world that shouldn't have been there. This widespread cash glut may be partly to blame for the global inflation that is happening right now. So we have been hiding the real supply and demand since 2008. Not just in the last 6 to 8 months when we've talked about a slowdown or inflation, because it has been building up in this system. One thing we need to realize is that if we want to reach real economic balance, all of that money must be destroyed in some way. So that's the backdrop. So now you know what would happen if you decided to take $30 trillion out of the world economy. I think that the world economy is worth close to $85 trillion. So $30 trillion is more than half of the world's yearly GDP. Things probably won't get back on track until 3 years have passed with no new money being added and careful money being taken out. So it looks like we're just starting what will be a long and difficult process. This will have a wide range of effects that will keep the markets on edge. If a recession is coming, you might also wonder why the jobless rate isn't higher. The problem is that even though global wage markets are fairly strong, the jobs that are being created may not all pay well. You also need to think about how much your assets are worth right now. It's a small part of a much bigger trend, which must be that the price of things is going up because of fake money. After all that fake money is taken out, I don't think it would take 6 months to find out what something really costs. So there will be a lot of tumult on the market. With this, we wrap up this episode of Informed Investing. Do you believe that the world markets are doomed? Or do you think this is just fear-mongering by vested interest? Drop a line in the comments and let me know. Thanks for watching. Please subscribe to my channel and hit the like button if you enjoyed the video so that you may be notified when I upload a new one.